Stock prices might seem confusing, but they all move for a few clear reasons, and understanding them can make investing much simpler and less stressful. At the most basic level, prices are driven by supply and demand. If more people want to buy a stock than sell it, the price goes up. And if more people want to sell than buy, the price goes down. While this is the foundation, the reason people buy or sell often comes from company performance. Investors closely watch earnings reports, revenue growth, product launches, and strategic business decisions, because strong performance attracts buyers and pushes the stock price higher, while poor earnings, scandals, or declining sales can trigger selling and drive prices down. For example, if a tech company announces a highly anticipated new product that could dominate its market, the stock may rise immediately as investors anticipate higher profits, whereas any negative news or missed expectations can cause sharp declines. Beyond the company itself, economic factors like interest rates, inflation, unemployment, and overall economic growth also play a major role in stock movements. Rising interest rates can make borrowing more expensive for companies and consumers, which may reduce profits and lower stock prices, while a growing economy generally boosts investor confidence and can push stock prices higher. Global events, such as trade policies, geopolitical tensions, or pandemics, also influence the market because they affect entire industries or economies, which in turn affects investor behavior. Another major factor is market sentiment, or how investors feel about a stock or the market overall. Emotions like fear, greed, and optimism can sometimes drive prices even more than actual financial results. During uncertain times, investors may panic and sell, causing sudden drops, while widespread optimism can push prices up, even if a company's fundamentals haven't changed much. News and events also have a direct and immediate impact. Announcements like mergers, acquisitions, regulatory approvals, major contracts, or even scandals can create sharp price movements as investors react quickly. Social media, online news, and instant reporting mean that information spreads fast, and the market often reacts in real time. Analysts' opinions and institutional activity are additional factors. When respected analysts upgrade or downgrade a stock, or when large institutional investors buy or sell significant amounts of shares, this can influence smaller investors and create noticeable trends in the stock price. Technical factors such as trading volume, short interest, and historical price patterns also affect short-term movements, as traders often use charts and patterns to anticipate trends. While daily fluctuations can seem random, stock prices are driven by a combination of investor behavior, company fundamentals, economic conditions, emotions, news, and technical factors. By understanding these drivers, you can interpret market movements more clearly, avoid panic during short-term drops, and make smarter decisions based on why stocks move, not just hype or fear. Stock prices do not move randomly, they respond to real information and investor reactions and to learning. To see these patterns can give you confidence in navigating the market, recognizing opportunities, and building a more informed investment strategy over time. In short, knowing what really moves stock prices can help you stay calm, make better decisions, and see beyond the daily ups and downs to the bigger picture of investing success.